Okay, we're going to continue our journey in Chapter 8, and we're going to look at how we're going to calculate the depreciation, which is the allocation of the cost of those long-term assets over its useful life. So on the balance sheet, we have our unused acquisition cost, but over time, we're going to use up that asset. Just think about your car. Over time, its value is decreasing. So we need to reflect the fact that we paid, say, $50,000 for our new car, and as we use it up each year, part of that $50,000 should be expensed each and every period, which would then impact our income statement. So depreciation expense represents the current year amount of our asset that we've used up. That shows up on our income statement. And then you may not remember this, but we talked about this in a previous chapter. When we depreciate an asset, we record that amount that we've used up as accumulated depreciation, which represents the total depreciation to date. In other words, the total amount of the asset that we've used up, which shows up on our balance sheet as a negative asset. Depreciation, again, is the process of allocating cost. It's not the process of determining market value. So when we're recording depreciation, we're simply saying we paid a certain amount for the asset and we're allocating that cost over its life. That doesn't mean that the remaining value of the asset recorded on the books equals the market value. The remaining amount probably doesn't equal the market value because the depreciation concept has nothing to do with market value. It's simply the systematic allocation of the cost of the asset over its life. The undepreciated cost is not a measure of fair market value. It's a measure of the cost of the asset less what we've used up. Doesn't mean somebody would pay that amount for the asset. How do we record depreciation? Well, we learned this when we did adjusting entries. We're going to increase our depreciation expense and our related contra account. The effect on the accounting equation is going to look like this. Depreciation expense goes up, which makes net income and equity go down, and then our assets go down. The accumulated account is actually going up, but because it's a negative asset, it makes assets go down. Remember, we don't want to credit the equipment, which would make sense because we're using up the equipment or the long-term asset, but we use the accumulated account so we can track the amount that we've used up separately from the original purchase price. The cost less the accumulated depreciation gives us what's referred to as the net book value. That's the amount of the asset that's left over and hasn't been used up. The cost is what we originally paid. The accumulated is what we've used up over time, and the net book value is what's left over. Some financial analysts compare the book value of assets to their original cost as a way to determine how much of the assets remain. So if we do those calculations for various airlines, you can see that there's only 66% left for Southwest, whereas JetBlue has 75%. What does this mean? Well, to me, it means that JetBlue's fleet of planes is probably slightly newer than that of Southwest, and United kind of is in the middle. To calculate depreciation expense, we're going to need three main components: the cost, the useful life, and then the leftover salvage or residual value, which is how much the asset will be worth when we're done with it. There are three different depreciation methods, so similar to calculating cost of goods sold, we could use LIFO, FIFO, average cost, or specific identification. GAAP allows us to use alternative depreciation methods: straight line, units of production, and declining balance. Each method will give us a different answer. Why a company chooses a method is their choice. All are allowed under GAAP. Straight line is going to be the easiest. Units of production would make sense when the more we use the asset, the more it gets depreciated. So think of like delivery trucks. The more mileage we drive those delivery trucks, the more we're utilizing the asset or using it up. So units of production might make sense. And then for some assets, we use a lot of its value at the beginning of its useful life and less towards the end. And that's when declining balance would kind of make sense. But it doesn't, again, need to fit with the asset. We can use any method. And because straight line's easiest, most companies use straight line because they like easy, just like you and me. The estimated useful life of the asset is an estimate that the company makes based on historical info. You can see that the estimated useful life of the various equipment that these airlines use range from 15 to 30 years. It depends on the company and how they determine the useful life. The differences in estimated useful lives and residual values used in the estimates can impact, obviously, the bottom line of the company because it's going to impact the depreciation numbers that we calculate. So we're going to use an example for Southwest. We're going to assume they purchased a new service vehicle with a cost of $62,500. They're estimating the residual value to be $2,500, and they plan to use it for 3 years or 100,000 miles. And then we're given some information about the actual miles driven in each year because we're going to need that for units of production. Similar to LIFO, FIFO, and average cost for cost of goods sold, I don't really care for the way the textbook presents depreciation. So I'm going to go off script and give you my formulas that I use to calculate depreciation, and then I'm going to go through an example of each utilizing my formulas and structure. If you like what you read in the textbook better, you're welcome to use that. It's the same exact answer you'll get in the end, but I believe my methodology is a little easier to understand. So I'm going to start by giving you the formula for each method. So we'll start with straight line. Straight line is going to have the asset cost minus the residual value over the estimated useful life in years. That's how you'll get depreciation. With units of production, it's going to be the asset cost minus the residual value over the estimated useful life. And here's a change, so I'll change my color. In units times the actual units used. The amount that we get from the first part of the equation is the depreciation rate. That won't change. That'll be constant from year to year. What's going to be different is the actual units used, like the actual miles driven of the service truck, that'll change. But the depreciation rate is the same, so you can get that once and use it in each and every year. Finally, we have declining balance, commonly called double declining balance. And that's going to be equal to the asset cost minus, in the numerator, we have accumulated depreciation divided by the estimated useful life in years. And then we take all of that and double it. So the reason I like to format the formulas this way is we start with straight line, and I kept all of the constants with straight line in red between all the formulas, so you can see that the structure is fairly similar from formula to formula with some minor tweaks. That allows me to remember these formulas a little easier. The other thing I want to note on double declining balance, so I'll put a little star there, is we never depreciate the asset below residual or salvage value. The first two formulas for straight line and units of production have that residual value right in the formula, so it automatically makes sure we don't depreciate the asset below residual value, but double declining balance does not have the residual value in the formula, so that may require that we make a manual adjustment, as you'll see in the examples I'm about to go through. So we'll start with the easiest method, straight line. And whenever I'm doing these, I like to set up a depreciation schedule. And in the depreciation schedule, I have year, depreciation expense, accumulated depreciation, and book value. And by setting up this schedule, I'm able to answer any question I could be asked. If I'm asked for just the depreciation expense, it's in the schedule. If I'm asked for the accumulated amount, it's in the schedule. And if I'm asked for the leftover book value, it's in the schedule. So I always start with year zero. Year zero represents the day you purchase the asset. And then we'll have 3 years because this asset's useful life is 3 years. And in year zero, there's no expense and no accumulated. And because the book value is the asset cost minus the accumulated depreciation, notice my abbreviations there, the book value always starts with the cost, which is $62,500 because there's no accumulated depreciation on the day of purchase. Then to get depreciation expense, we're going to use our straight line formula, which is the asset cost minus the residual value over the estimated useful life in years, and that's going to get us $20,000. Once I have that number, the beauty of straight line is it's going to be the same each year. So there's no point in recalculating it. It's going to be the same number each year. Then my accumulated is going to accumulate. So we start with 0 plus 20, and we get 20 at the end of year 1. Then 20 plus another 20 brings me up to 40. And then 40 plus 20 brings me up to 60. And then the book value is reduced each year. So it's $62,500 minus 20, which is $42,500. Then $62,500 minus 40, which gives me $22,500. And then $62,500 minus 60, which gives me $2,500. That number is important because that's the residual value, and that's exactly where our assets book value should always end up, no matter the method we use. In the last year of the asset's useful life, book value always equals residual value. I'm going to say it again because it's really important. In the last year of the asset's useful life, book value always equals residual value. What that means is if I ask you for the book value of the asset at the end of year 3, no matter the depreciation method used, you don't need to do any work. It's always going to be $2,500, the residual value. Let's move on to declining balance. So I'm going to set up the same type of schedule. We'll have our year, depreciation expense, accumulated depreciation, and book value. Year 0, 1, 2, and 3. And then in year 0, there's no expense, no accumulated, and the book value again starts with the cost. To get our depreciation expense using my double declining formula, I'm going to take $62,500 minus the accumulated, which at year 1 is always 0 because you haven't depreciated anything yet, divided by the estimated useful life in years, which is 3. I don't know why I wrote 4. And then we double it. So I'm going to need a calculator for this one. 62,500 divided by 3 times 2 gives me 41,667 rounded. So that means the accumulated is 41,667 and the book value would be 62,500 minus that, which is 20,833. Then in year 2, it's going to be 62,500 minus the 41,667 in accumulated depreciation, divided by the estimated useful life of 3, and then we double it. I should probably put parentheses to show you my order of operations. Also note that the numerator really represents book value. So rather than going through and doing 62 minus the 41, I could just use the previous book value for the numerator of 2833 divided by 3 times 2 gives me 13,889 rounded. And then we add that to the previous 41,667. And our accumulated is 55,556. 62,500 minus 55,556 is 69,444. Then in year 3, it's going to be 62,500 minus the 55,556 divided by 3 times 2. That gets me 4629 rounded. Add that to the 55,556. I get 6185. And then 62,500 minus that gives me 23,415 rounded, 2315. But at this point, you may remember I told you that double declining does not automatically take into account residual value. So we need to compare our book value to residual value. And when we do, no! Hope I didn't scare you too much, but that's exactly what we have to say. No, this is wrong. We can't go lower than 2,500. So that means we over depreciated the asset by the difference, which is 185. So we went too low by 185. So we have to manually override our depreciation, reducing it by that 185. So 5629 minus 185 gives me 4444. That is going to make my new accumulated 60,000. Which then makes the book value 62,500 minus 60, or 2,500, which is what I want it to be. So the problem with double declining balance is that we are not going to automatically get it to go down to residual value. So in the final year, we need to compare the book value that we calculate to the residual value to determine the appropriate amount of depreciation. You could have also just said after year 2, 6944 is where we ended up. We go down to 2,500. So if I take 6944 minus 2,500, that gives me the 4444 I needed for year 3. So you could have just done that for year 3 without actually doing any of the calculation with the formula. This is only an issue for double declining balance because double declining balance is the only method that does not include the residual value in the formula. Last but not least, we'll go through and do units of production. So we have our year, depreciation expense, accumulated depreciation, and book value. Year 0, 1, 2, and 3. We have no expense, no accumulated, and the book value starts at our cost. The first thing we need to do is get our depreciation rate, which is going to be the asset cost minus the residual value over the estimated useful life in units, which would be 100,000 miles. That gets me a rate of 60 cents a mile. That 60 cents a mile is useful to know because I'm going to use it every year. So to get the depreciation expense for year one, it's going to be 60 cents times the miles driven in year one, which is 30,000, which gives me 18,000 for my depreciation expense. In year two, it's going to be 60 cents times 50,000, which gives me 30,000 for my expense. And in year three, it's going to be 60 cents times 20,000, which gives me 12,000 for my expense. The accumulated will go from 0 to 18. Then 18 plus 30 is 48. Hate how those random lines show up, but I can't help it. And then 48 plus 12 brings me up to 60. The book value is going to be 62,500 minus 18 for year one, which is 44,500. Then we're going to do 62,500 minus 30, which gives me, 62,500 minus the 48, which is 14,500. And then 62,500 minus 60, which is 2,500. And ding, 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 that's the residual value, so I know I've done it right. So when all is said and done, all methods bring us to the same end game, which is at the end of the asset's useful life, the book value equals the residual value. Double declining is the only method where we have to do a manual adjustment to make that happen. I'm going to skip over these several next slides because you can see that the book uses the different formulas to arrive at the same answers, but I just don't like the format of the formulas. I find it confusing and difficult to understand. I don't write the book, so my goal is to provide you with a way that I think is easier to understand the material. If you like the book's method better, I won't be offended. So I'm just going to skip through these slides really quickly. You should notice that we end up getting the same answers using the book method or my method. And then we get to a summary. So the formulas that the book uses are here. I don't like those. I already gave you a summary of my formulas. But it's important to know that straight line gives you an equal amount each year of depreciation. Units of production is going to depend on how many units are produced. And double declining balance gives you a whole lot at the beginning, and then the amounts decline over time. I think a picture is worth more than 1,000 words, so straight line gives you a straight line, a constant amount each period. Double declining starts with a lot of depreciation at the beginning of the asset's useful life and then goes down dramatically. And then units of production, not shown here, depends on how much we produce, so it would start here, then go up, and then go down again. I don't know. It depends on how many units the asset is consuming each year. Bottom line is, as you can see in the graph, straight line kind of hits up in the middle. So most companies are going to use straight line because it's kind of where you're going to end up anyways, in the middle of it all, and it's the easiest to do. But you still need to understand the impact that each method would have. Double declining is always going to give you a higher depreciation in the asset's beginning of its life and lower at the end. Units of production really depends on what the usage is, and straight line is going to give you the same amount every period. Because each method gives us a different answer, we need to disclose the method that we use in the notes to the financials. And then financial analysts are particularly interested in any changes to accounting estimates, because if we change the estimated useful life, it's going to have an impact on the end result of our depreciation, which in turn impacts net income. As an example, Singapore Airlines disclosed in its annual report it increased the estimated useful life on its aircraft from 10 to 15 to reflect a change in its replacement policy, and that resulted in reducing depreciation by $265 million each year, which in turn resulted in increasing income by $265 million each year. So it's important to look at the notes to the financials, because a company may appear to be doing significantly better, but in fact it's just a result of them changing their estimates or methods of calculating depreciation. Under GAAP, the goal is to provide useful information to decision makers. Financial reporting follows GAAP, but the IRS's goal is to make money to cover the expenditures of the federal government. So a lot of the times the provisions in the code, the Internal Revenue Code that is, are made to encourage certain behaviors that are thought to benefit society. And one of those things with respect to depreciation is that the IRS allows accelerated depreciation for tax purposes, even if you use straight line for book purposes, which most companies would do because it's easier and generally is going to result in less depreciation, at least initially, which results in a higher income for the company. Why does the IRS allow us to have our cake and eat it too? Well, because the IRS thinks that if they promote investments in long-term assets, it'll promote business growth, which in turn is going to promote higher incomes in businesses, and in the end, higher taxes will be collected. So that's why the Internal Revenue Code rules are different than GAAP rules.